Might have heard that there was a Fed decision today, a rate hike, widely anticipated, no surprise to the market. What was a surprise, though, was the Fed decided to change their glide path, their guidance. So we had the 1/4 point hike, which was expected, but they were only supposed to telegraph 2 rate hikes for, if you want to do the American or the German, 2 rate hikes. I guess L for loser in this case. So they bumped the 2 to 3, and that was not what the market wanted to hear. That is a little bit disturbing. What I think got the market upset were a few factors that went into this today. Number one, there was a huge level of complacency, meaning the market was up into this Fed decision. You know what I say, and this will always be a consistent theme for me. I don't like up into Fed decisions. It's just never ends well. It's always somebody's disappointed with something, and in this instance, there was something to be disappointed with. A couple of nuances that I'm going to get into, and you might get confused with what you hear on TV. Let's just go through this. This is what really matters here. They talk about the moderate pace of growth. They talk about solid jobs. They mentioned that their inflation expectations, this is a biggie, increased a little bit. I'm going to couch that with a bit of a sideshow discussion here. They talk about inflation expectations rising, but the big metric that I watch is the wage growth. You have year-over-year decreases in wage growth, and the job quality that they keep discussing is improving. These solid jobs is mostly part-timing. The unemployment rate, they always discuss this sub 5% number. This is complete fiction. If you factor in people who are basically part-time or unemployed, or they've been unemployed so long that they no longer count, you're probably somewhere in the low teens. I could even make the argument that you're in the mid-teens, but I'll keep it a little less controversial, and we'll say the low teens. And by the way, that's a big cycle here because we have automation and you know what I love? We've been talking about automation and AI for a while, and now it's kind of seeping into the lexicon. The Fed seems still to be in a little bit of denial, but I think that they're slowly waking up to that fact. They talk about the 2% inflation over the next couple of years. If they aren't even reaching their inflation target, I don't know why they're hiking and telegraphing 3 rate hikes. I think I know why, though. So why did the Fed say that they were going to do 3 hikes instead of the 2? I think it comes down to how they handle their, as crazy as this sounds, how they handle their GDP estimates. Often when the Fed lowers their GDP estimates, I've been noticing this trend, and this is like, if you go back to their releases, this is becoming a trend. They often lower the GDP more than they want to, and then like in the next few days, they back it off a little bit. They raise it. So it's almost like they have the drop and then the raise. So that just seems to be what they're doing. So maybe they wanted to say 3, and then they're really only going to do 2. But I will say I listened to Janet Yellen's press conference, and she was the most hawkish I've ever heard her. That was not a dovish press conference. I'm not going to sugarcoat it any way. There is no sugarcoating what came out of the Fed today. They were hawkish. However, she backtracked it a smidge. She kind of said that they'll evaluate the data as it comes in, and they'll adjust their rate hike expectations. So they're getting hawkish, but they might go back to being more dovish. It was sort of they always do the double speak, but today they wanted to be a little bit more hawkish. That was the tone I took from Yellen. They said, and this is when you got the bounce in the market. You originally had the move down, the move up, and then the resumption of the move down, the typical Fed ABC pattern. And the market, when it did bounce, was basically when the Fed upped its growth expectations. My problem with the Fed upping their growth expectations, and we know Trump and all, the repatriation, the lowering the interest rates, the more repealing regulations, the more pro-business stance, all good, all valid, and the Fed seems to be acting accordingly. They are upping their growth expectations. So I didn't take so much offense to that. But what I do take offense to is that the Fed projecting growth, I mean, they've been a joke. I mean, they've been wrong since basically when they started the rate hike cycle in like 2005, 2006, when Greenspan just kept on hiking and hiking, and we all know how that ended with the financial crisis. The Fed picking their inflation numbers, and I'm going to go through. I'm sorry, their growth and inflation and employment numbers is almost like playing spin the bottle at a petting zoo. I mean, it's like either you're kissing a pig or kissing a monkey. Or I mean, like they're so wrong. They've been so wrong for so long. I mean, and what's crazy is that us, Wall Street, keep going back to them for estimates. It's like the gang who couldn't shoot straight. I mean, it's some of these expectations are laughable. I mean, if you worked at a Wall Street firm and you gave some of these, they're so wrong, it would just be like you'd be fired. I mean, you'd be shining shoes. It's so bad it is. They talked about growth picking up. In business, investment is still soft. Hopefully, Trump's meetings with businesses, that's going to help. That's a biggie for the Fed. They talk about GDP growth. They upped their expectation from 1.9% to 2.1% in 2007. Yay, they're over 2% again. So we must start hiking rates. The Fed just got themselves into a bit of a better pattern here, and now they want to start pouring the cold water on the growth already? I mean, with hiking rates? I mean, what's wrong with these people? 2018 and 2019, they're only at 2%. I mean, this is an effing joke. I mean, they should, I'll tell you, honestly, if these numbers, if this is what their expectation is, this is the best they can do, they shouldn't be hiking interest rates. They should be doing more QE. This is a joke. 2% is a joke. It's terrible. Any type of shock to the system, like Japanese earthquake or a war, and Trump bringing in the CEO of ExxonMobil as the Secretary of State, to me signals that he might want to really make good on his plans of taking the oil. No one's talking about that, by the way. What better guy would you want to have as your Secretary of State if you're planning on taking the Iraqi oil than the CEO of Exxon? You heard it here first. Anyway, these could be shocks. Why would they want to... Anyway, I think I made my point. The employment, they talk about 4.7%, and then the long run rate is 4.5%. Nothing to see there. The inflation rate, this to me was what was hilarious. They talk about 1.5% up to 1.9% next year, still below their 2% target for an entire year, and only getting to 2% in 2018 and 2019, and now they're raising rates, so they're making the gap between where we are and their end target even further. That makes no sense to me. I mean, but this is the world of central banking that we live in. This to me was interesting. This is what I think roiled the markets, and I don't think a lot of people picked up on this, but I, of course, did, and I will explain it. They talked about their Fed funds, the median projections, 1.4% in 2017. 2.1% in 2018, 2.9% in 2019, but their long-run end target was 3%. That's up from 2.8%. Since the Fed has started this calculation from 2012, that number has never gone up. It has only been down, and this is the first time ever it has ticked up. I'm not reading too much into it other than the fact that this is the first time ever it happened. The Fed has talked about their normalized rate. It's usually close to 6% before there are market crashes. They've supposedly learned from the error of their ways, and they now are capping it at 3 to 3.5% from what I've heard from past Fed discussions. That's sort of where they see the end game going. So that isn't necessarily super-duper bearish, but in the world we live in, with 2% growth and needing low interest rates for PE multiple expansion for growth names. I mean, if you look at all the names that basically took a nosedive into the after the Fed, it was all like the FANG names, the ones that require the low interest rates for the PE multiple premium. We're in a low interest rate world. Do they still deserve a PE multiple premium? The answer is, of course, yes, but not the same degree of PE multiple premium. So that's what happened today. That's what the market didn't like. It didn't like there was a lot of complacency. You had a very low VIX. You were up at a, we'll talk about technicals for a moment here, which you'll see it, by the way, more in the weekend review video, and you could even see in my last weekend review video. You had a S&P and an IWM that hit the channel highs and now pulling back. So even if you took the Fed and you took everything, all the noise out of it, technically speaking, the market was due for a bit of a pullback. And I'm not saying that, you know, it's crash time and the market's completely topped and all of that, but I will say this. We got my 1.618 Fibonacci extensions on the near time frame, which we had talked about. That was 226.53. We topped out at 228.34 in SPY. IWM blew past that. We got my 138s that I had been talking about, and we're pulling back. I mean, this is just normal price action. You've had ginormous moves. So I've had a lot of people saying, "Oh, is it time to short?" My answer is you could put on. I'm not saying crash time, by the way. Someone is saying it's crash time. I'm not saying that at all. What I am saying is that you could have a bit of a pullback. The trend, you're still making higher lows and higher highs. Before there's going to be a ginormous pullback in the market, and I know everyone wants to kind of catch the top tick, you're going to first, in my view, after making all-time highs like this, have a pullback, a rally to a lower high at the very least, and then maybe you get the bigger move. So I know a lot of people have been loading up short. They think that, you know, we're at a low VIX, we're at market highs, we've hit end targets. Yes, it's possible that there's a pullback, but I don't know that you're going to make money from it buying puts because it might take longer than you think. And I think a lot of people, the same people with that kind of logic, assume end ranges. If you're looking for a quick pullback, like to, you know, the 10-day MA, which we got today in the IWM, or like a 20-day MA test, sure, knock yourself out. But I don't know if you're going to be able to hold and see, you know, some kind of monumental collapse in these indices. IWM, if it were to pull back, and this is very interesting, at least to me, if you were to project down, let's assume we get to the channel low, and I don't think it's going to be like a straight shot there. I think that there could be a lot of chop. It's also possible we make a move to the middle of the channel, which is, believe it or not, the 20 MA, and then we could just kind of chop for a while. The IWM has done this before, where it has these pullbacks, rally back up to the channel high, and these kind of pullbacks, and it just kind of rides the channel higher. It's very possible that happens here. On a longer term time frame, I have my 1.618 Fibonacci extension up to 151 in IWM. That, I know it's a lot. If we were to pull back to the channel low, which will coincide roughly with a 50 MA, and this would probably happen in early part of next year, you'd be basically pulling back to the breakout of 129.10. I'll show that in the weekend review, by the way. It's near where the breakout, well, it is the breakout. It's where the reference highs were. It's the channel low. The 50% fib, assuming there isn't a higher high, is roughly around 126.85. So somewhere in that area, I think would probably catch it. That's a pretty big pullback. But in the context of things, you could still remain bullish in that range, as crazy as it sounds. So I'm more interested in buying the dip down there than I am necessarily looking for some type of a major crash. Not to say that we're not going to pull back, and I'm saying that it's very possible. I think, and this is what we're going to use, and I always use this, I like to take opinions out of the equation because everyone has them. They're sort of, there's a saying that's a little bit crass, that opinions are like blank, everyone has one. You add in the body part. I'll say this. Fed day ranges, meaning today's range, is what I like to key off of. Anything above the high I think is going higher, and anything below the low I have to assume is going lower. So below today's low is a right or right out short. Above today's high is a right or right out long, and inside of range is just hang out and answer emails and do chart work and just do whatever. That's the way that I will be trading this. That's the way I always trade Fed days. So that's my thinking. If we were to, I'll tell you, if we were to pull back just to the 20-day MA, it would probably move up a little bit. It would be in like the 222s. So I mean, that's what we're thinking. when I say we, I mean me. If we were to get a larger pullback, and this would be to like retest the breakout points. By the way, not super bearish either. It's a big point-wise pullback, but again, nothing pattern changing. The breakout, in my view, here was, of course, 219.60, which was the old high, and a 50% fib is 218.36. That roughly is really where the breakout took place. There was sort of the big up move, the doji inside of it. The high of day of that doji was 218.31. You could pull 10 points back in SPY. It's a lot of points, and it would still be kind of, quote, okay. So that's what I'm thinking. I don't know that move would be a straight shot either. I think it could be very choppy. I think it could be something that would be grinding. So keep that in. I wouldn't do it with like weekly puts. You might want to like buy out in January or February's if you're looking to kind of make that move. A couple of things that bothered me today for the bear thesis. When the market was rallying, the VIX was up, and then when the market was cracking, the VIX was down. So that goes back into my question about why was the VIX rallying when the market was rallying. That's often a sign of kind of a market top, but it wasn't following through. You'd think it would have really elevated with the market going lower. I think it was actually going up with the market because of speculative call buying, as crazy as that sounds, or hedging. So that's my take on it for now. What was there something else I wanted to talk about? I talked about something in the a tweet that I put out, and that was that the market moves to extremes basically out of necessity, not out of like logic and reason or rationality and reasonability. And the answer to that is for a few reasons. I'll explain that now. I'm trying to think about how I want to word it, but let's try this as an attempt. So how does the stock market work? How does price move up? Usually it's not because of you or I. We don't have big enough size to do that. But it's out of institutional buying. And these are people who trade in millions of shares. Not a couple of hundred, not a couple of thousand. They're not buying 10 by 20s in, the SPY like you or I might, or 1 by 2s or 5 by 10s or 20s by 40, whatever. They are buying huge size. So when they sell, their selling can depress the price of the stock. So what they need to do is think in averages, average price. So in order to, let's say, get an average price of, let's say, 100 in a stock, they might have to mark it up to 110, 120, maybe even further. And they sell rallies on the way down, or they just sell on the way down. So what they'll do is manipulate a stock higher. And when I say manipulate, they'll buy a stock higher to the maximum point where their buying no longer can move the stock up, meaning they hit a brick wall, that no matter how much more they buy, they can't move the stock up, and that's the point where they start their operations to sell. So when I talk, and also people are getting squeezed, right? So you have a powerful combination of the people who are right, raising the price up to that maximum point where they can start their selling operations from and still be able to get a good price, and the people who have exhausted their buying power because they've been short. So that's what I mean. It doesn't happen out of rationality. It happens out of necessity, meaning you have the people who are wrong on your side. They're very powerful agents. You have underlying conditions, which means improving from bearish to bullish, or vice versa if the market is deteriorating, and the people who are right. So that's what I meant by that. I hope that was clear. If there's any questions, I could try and answer it. There's a great book that handles this. People are always asking me what books to read. There's a book that was written, I think, in like 1908, I want to say, by Selden. It's called The History of the Stock Market. Phenomenal read. You know, we always think we're so sophisticated now. Those guys back then in the early 1900s knew what they were doing. Probably better than some of these movie stars we see on television. So that's the story with regard to that. I want to keep it really simple today. I like I said, most stocks above today's high is a long, below the low is a right or right out short, and in the middle is a just no touch. I noticed something interesting in Apple. So I know that's one of the stocks. Let's just start ticking off some of the stuff you guys want to talk about. Apple has had a bid. I've noticed when the market pulls down, it winds up kind of bouncing. And I had said I wasn't sure if it was a buyback or a real larger buyer, but there's an underlying bid. One thing today that had me thinking maybe toward the end of the day that it might have been buyback is that buybacks kind of stop in the last, like, I think 30 minutes or hour of the trade, and that's sort of when Apple sort of tailed off, but the market tailed off also. So that's still inconclusive, but I am seeing an underlying bid in Apple. Anything above that, what was it, 112.38 or 112.39? Was the break. Yeah, 112.39 was the breakout. These 115s were where a kind of a left shoulder might have taken place. I wound up taking a bunch of profits in the 115s. I talked about that yesterday. You're getting close to a channel high, but it seems to me like Apple will want to fill that gap to the 118, I don't know, what was it, 118 quarter. So that's what I'm sort of thinking, that it might not do it this week, because there's a lot of OI, open interest, in the 115s, and usually the first look into the gap isn't the one that goes. It sort of pulls back first and then goes. So that's what I'm thinking. But as long as Apple holds like the 50 MA in that breakout area, it should be all right. There was a gap in Apple from 113.30, so I'm thinking between 113 to 115 is sort of just like the neutral range. Below there, I'd get a little more cautious, and above, I'm thinking the 118. So I think it's a trim and trail situation here. Exxon had a very, very clean breakout a couple of days ago on the Rex Tillerson being the Secretary of State and the non-OPEC guys getting involved. Today was a pullback. I think it just got a little too far too fast, but I think these 89s roughly is the new floor for Exxon. Maybe it would get to 87.44, but that area between 87.44 and 89 should be like what 82 to 85 used to be. So you can just up that range. I like still buying dips in Exxon. Chevron oddly didn't have much of a pullback in that area. Again, it was a little stronger, but you've now had 3 days of selling. I think these things just got a little ahead of themselves, and they're in pullback mode. With regard to the big daddy of them all, which is oil, it got a range high, an old range high of 54.24. It got a little bit above that, pulled back today to fill the gap. Anything below 52 to me is a little vulnerable to 49. At the very most, I think maybe 47 would be like kind of like the end. That's the middle point of where the breakout took place, between 46.90, which is the 61A to the range, and 48.36. And you also have a 50 MA in there. So if 49s hold, then I think we go back up. If they fail, then I think we get a 50 MA test. That's sort of just it. It just, to me, we had a look below and fail, and that's when the rally took place. Now we have a look above and fail. I think it was just, again, because we came up from the bottom. Remember when I talk about coming up from a bottom, a breakout is more suspect? I think people have been waiting for that, and they just took the profits. So I'm not going to say that I think oil is fully rolling over here, but there could be a little bit more pullback before anything goes higher. The trend, now is higher lows to higher highs. So that's sort of what I'm thinking with regard to the oil. That was Exxon. Let's go back to since we're into the keys, the market keys here, when we're talking oil. When I talk about market keys, I'm talking about the VIX, the bonds, the dollar, China, and then the IBB, and, a couple of others in there, the high yield and stuff. With regard to the dollar, this to me is an issue. There's a couple of ways you can look at the dollar today. I want to be delicate with how I handle this because this is a big point of contention. Today was a mini look above and fail, just because we closed below the 102s. The dollar seems like it's going higher, though. If we break out, it's been consolidating in a range for a while. 102.098 was the 61.8. It got there, it promptly backed off, and now we're back there with a pretty solid reversal pattern with consolidation. If 102 is breached, it seems to me like this could see 109.32, which would be the doubling of the range, and you have another fib there at the 78.6 is at 110.53.9. That will not go down very well in S&P land, in my view. I don't think the market would like that. That could be the cause of the pullback, the dollar moving up, and the Fed being more hawkish. I'm curious to see if the Fed is going to walk back, like I said, walk back some of the tough talk, but we'll see. The bonds today, the Fed obviously, like I said, was more hawkish. You have a pretty big range today. It was like a bit of an outside, it looks like a bit of an outside day. 114.88 is the reference low, and you have a trend line low just below there in the 114s. So that area to me would be an interesting area for a right or right out long. If you were to get above today's high, like in the next day or two, tomorrow or the day after, 119.21, I think you could buy stop that for a move back up to the 123s, 123.15 to be exact. So that's the way I'm kind of looking at the bonds. I think the Fed being more hawkish than we had kind of originally expected is now the explanation of why the banks have been trading like they've cured cancer. They are obviously going to benefit from that, the net interest margin. So you have like Goldman Sachs, for example, you now have a multi-day consolidation. The 10-day has been roughly the support. As long as it can hold the 10-day, it'll go higher. If you lose the 10-day, then I think you see the 20-day quickly. You know how I've been playing this? Loss of 10 days, get 20 days. Loss of 20 days, get 50s, and 50s, 100s, and 100s, 200s. I'll keep it real simple. That just seems to be what works. I'll keep doing what works, like traders do what works, until it doesn't work. So as long as you hold the 10-day, I don't really see, and Goldman made a new high today. So I think you could use today's range as a good guide. Bank America got the target and what I had been looking for, the 1.618 fib up in the 23s. Today was a bit of a look above, and I don't want to say look above and fail, but it was a bit. Again, today held the 10-day. I think you could use today's range as a gauge. Anything above the high will likely go higher. Anything below the low will probably pull back, maybe to the 21s, maybe lower. The breakout was 1803. The 50% fib is 1712, and that I don't know if we would get that low, but if you were to get that, it would be a load the boat type of situation. But now with the Fed going, being more hawkish, I don't know how much these are really going to pull back. So that's the story with that. Ameritrade, I had got a question about that. So I had this conversation on, I said I thought we were going to see 47.81, which is the 1.618 fib extension. I still think that could be in the cards. Today's range, though, you have the low is on the 10-day MA, and the high was 44.11. So you could buy stop the high or sell stop the low, and that would be below a 2-day range and below a 10-day, and you'd probably get a pullback to the consolidation channel. The 20-day MA is 41.35. If you were to continue on, that would be like 40. Really the pullback range low, which would be like 40.35 to 40.5. That was Ameritrade. XLU. Let's take a look at that. That's the utilities, right? The ETF. Not a pretty situation. This to me looked like a head and shoulders. I don't want to know anything about this long until we can clear and hold the 200 MA with back-to-back closes. I don't want to say one close because we got that on Halloween, and then it has not been able to close. Today you got to look above and fail. So I could safely say maybe you want to buy stop over the high today. That to me would be a pattern shift if you could get over today's high. So below the low, I think it goes lower, and above the high probably goes a little higher. Gold, I have so many people asking me about gold. I don't think it'll bottom until they stop asking me. It didn't hold the 61A. Can everyone still hear me? It's really annoying with the Periscope. Today was not a pretty day. Gold should have held the 61.8, which was 112.04. It didn't. It's going lower. I have so many people who are interested in looking to buy gold. I mean, gold peaked in 2011, and people are still, trying to call bottoms in this thing. The 78.6 is 106.85. I think that area will be a point of contention. If that fails, though, you're looking at a retest of 100. The best thing that could happen to gold is it's a straight shot there, and then it's so oversold it's a buy. Like I would sell out of the money puts there. But again, today's range is very key. To me, you'd really have to get back up above 110.98, which was the high of day, and the 10-day moving average to even have, for me to want to be long gold. Like if there was some type of a reversal move tomorrow or the next day, then maybe today was a look below and fail. So I think you could buy stop over 110.98 or wait for lower prices. I kind of feel like, and I keep saying this, people keep asking me, when is gold going to bottom, when is gold? And I keep saying, I don't know, but I know I'll know it when I see it. Like there'll be this big push down, I think, on big volume, and then you'll get like these price target cuts to like ridiculously low numbers, and then it's sort of, it's going to be the end of the gold move. HYG, let's talk about HIG. That's a really important one. That's the high yield over the bonds. You have a double tweezer high in there at 86.84. Today was a retest of sort of the breakout. So again, today's range over the high of day, you don't want to be short it. I think you could be short against the high of day on a break of the low tomorrow for a right or right out trade. This was an inverse head and shoulders pattern. Today was just the check back. So I really want to use today's range as the gauge. We closed a little bit below the 50, which was where it broke down from. If you get a close back up over the 50, I don't want to be short, but I guess you could kind of try it as long as it's below the 50 MA. So that's the HYG. If that starts kind of coming down again, that's a bit of a problem. Again, that's always kind of keyed to oil. Someone asked, I've been getting a lot of questions about Tesla. It was up a bit today. This Tesla needs to clear and hold the 200 MA before there's any sustainable rally. It's sort of near like a volume distribution low. I think that this is just going to be choppy until they get the capital raise out of the early next year. A capital raise out of the way. NVIDIA. This is sort of like the poster child for a bull stock. I've been saying that this stock will likely see 100. It may even overshoot it. Did I have an upward projection? I didn't. I'll work on that for the weekend review, where I think that I'll make my attempt at trying to pick a top on this. I don't really like to do that. I've said that the backside of the channel would be support. It has been. The only short trade I even decided, the only trade that I saw short in here was the break of the 10-day that got to the 20, where I said to promptly cover. It happened a lot quicker than I thought, and then it was back off to the races, and that's it. Tactically, it seems late in the year for this stock to really get clobbered. Next year, maybe it has some issues, but it seems like it's going to, at the very least, test the $100 level. Was there anything else I wanted to talk about? Someone asked me about, I always get asked about Twitter. Dorsey was left out of the conference today. He's, I don't know. It just seems to me like this thing is going to chop. They need to put 2 solid quarters back to back. before with MAU growth. I mean, this is probably late in the year, and it'll probably be like maybe a 2017 story. I have a little long, but I mean, I don't really honestly even watch it anymore day to day. The agriculture stocks, someone asked about this CF Corp. This looks like a breakout of range and a consolidation. I guess I'd be interested in buying it on a pullback, maybe somewhere in the 25s or 26s. Like I'd sell out of the money puts, maybe like 24 puts or something along those lines. So that's what I'm thinking. I have a little long in potash, the POT kind. This had a look above range that failed. It's kind of pulling back in. So did it break trend? Let me see. Potash. Let me just draw this trend line in. Yeah, right on trend here. So I like it for right or right out, maybe against the 20 MA. But if it loses that, it could pull back even to mid-range and see 17s again. This thing to me looks like it is just kind of putting together a base. I think the reason that it failed was it came up from the bottom. Came up right from the bottom. It was just too much too fast, and now it's pulling back. But to me, the pattern looks like it's trying to shift a little bit into these ag stocks. And if we do start seeing some inflation, that will translate into these stocks. Someone asked me about this CRM. I think we'll end on this. This to me just looks like a bear flag here. It has a higher low in. If it could clear 72.27, maybe there's a move up to the 75s. Yeah. Anything, though, below 69.58 is probably a right or right out short. So that's kind of what I'm thinking. It's either a sell below there or a buy above. So a short below 69.58 and a buy above 72.27. I think that's where we might call it a day for this broadcast. But let's keep in mind we're thinking in time frames and probabilities here. I think that a lot of these markets just moved a little bit too fast. I don't know that we're in full collapse mode. I don't even think that is the situation. I think we're in like sideways consolidation mode here for a little bit. The Fed, like I said, was hawkish. There's no sugarcoating it. They were hawkish. They raised their target, their amount. I'll just say this though. They said 4 hikes last year. We had 1. They said 3 hikes this year. I think that they wanted to build in a little buffer if there is more growth, because I think they see what's happening. They did up their growth projections. If they're right about the growth, the market should be able to digest the 3 hikes. If they're wrong, that's a problem. I'm going to keep an eye, like I said, on the range, and I want to see what kind of comes out of the Fed maybe in the next few days. The dollar is going to be the guide. If the dollar keeps rallying, I don't think that that's going to be good for the S&P. It should be good, though, for IWM. Keep that in mind. A strong dollar is great for domestic stocks. Let me see, where is IWM? Yeah, right on the 10-day today. You broke a very steep trend, but right to the 10-day. I would be looking on a bounce if you want to protect against IWM, or if you must be short, maybe some kind of a put spread or a put ratio that somewhere ends around the 129s. Around there would be good. Anyhow, that's my story. I'm sticking to it. If you missed this video, or you want to watch it again, I'm going to upload it to my YouTube channel now. That's Justin Pulitzer Trades. Subscribe to my YouTube channel. It's free. And you'll get notifications when I post new videos, weekend reviews, special edition videos, which I'm currently working on one, and of course Periscope rebroadcasts. So let's have a good rest of the trading week. I think we've discussed the key levels here, and I'll get more into some of the technical kung fu in the weekend review video, which of course I post either on Saturdays or Sundays. Cheers.